Why is a company 1.7% away from losing 90% of its revenue offering a 10% dividend yield? This isn't a stock, it's a regulatory time bomb. Hello everyone, this is Quantum Cats. Today we'll look at the Phoenix Education Partners IPO. They're the parent company of the University of Phoenix, known for adult online education. This is not your typical growth stock. It's a high-risk cash flow play. The thesis is built on yield spread arbitrage trading massive regulatory risk for very high immediate income. The company will list on the New York Stock Exchange under ticker PXED. It may go on public on October 8. The offering is a full secondary sale of 4.25 million shares. That means private equity sponsors Apollo Global Management and Vistria Group are cashing out after an operational turnaround. Despite their exit, the business itself is stable. It has no corporate debt and generates steady profits. In the last 12 months ending the 31st of May 2025, revenue reached $990 million. In the first 9 months of FY 2025, net revenue climbed to $750 million, up from $710 million in the prior year. This strength supports a strategic dividend. Investors will receive about $0.84 per share every quarter. Based on the $31 to $33 price range, that works out to a massive 10.2% to 10.8% annual yield. That ultra-high yield anchors the valuation. It implies a P divided by E multiple of about 9.5 times earnings, far below peers like Grand Canyon Education, which trades around 25 times. But here's the catch. The discount comes from extreme regulatory risk. The biggest issue is compliance with the 90/10ths rule, which requires for-profit schools to get at least 10% of revenue from non-federal sources. New rules took effect on the 1st of July 2023. Federal tuition for military and veterans now counts on the restricted side. That pushed the University of Phoenix's federal funding from 81.2% in 2023 to 88.3% in 2024. This leaves only a 1.7% buffer before breaking compliance. If the school crosses that line for 2 years in a row, the result would be catastrophic, loss of nearly 90% of its revenue. So the trading strategy here is simple. A fundamental stop loss must be tied directly to regulatory stability. That's all for today. Personally, this is not the kind of company I would buy. But what about you? Would you add it to your portfolio? Share your thoughts in the comments. Thanks for listening. This is Quantum Cats. See you next time.